If you receive Social Security or a pension, your bank may already be applying a new rule to your money, and most people don't even know it yet. Let's start at the beginning, because I want to make sure this makes sense to everyone watching. Whether you've been managing your finances for decades or you're just now trying to figure out how these systems work, I'll explain this in plain English, I promise. So here's what's happening. In 2026, federal banking regulators working alongside the Treasury Department and a handful of major financial oversight bodies finalized a new rule, and it's being called informally the 250 bank rule. Now, when people first hear that name, they assume it means something was taken from them or that there's some new fee or that their account is being penalized, and I completely understand that reaction. But this rule is actually more nuanced than that, and understanding it fully, not just the surface level, is exactly what's going to help you navigate it without stress. So stay with me because this part is important. The $250 figure itself refers to a new federal threshold that banks are now required to follow when processing and holding government-issued benefit payments. Specifically, if you receive Social Security retirement benefits, Social Security disability insurance, what most people call SSDI, supplemental security income, which is SSI, veterans benefits, or a federal pension, your bank is now operating under a new set of rules about what happens to that money the moment it lands in your account. And the key word here is protection. This rule was designed, at least on paper, to protect benefit recipients. But like most financial regulations, the details matter enormously. And there are things buried in the fine print that you absolutely need to know about. Here's the core of what changed. For years, there's been a long-standing federal law called the Account Garnishment Protection Rule. You may have heard of it. Basically, it said that if someone had a judgment against you, meaning a creditor, a debt collector, even a payday lender, they could not simply reach into your bank account and take your Social Security or federal pension money. That money was supposed to be protected. And in theory, that protection existed. But here's what a lot of people don't realize. In practice, it was full of gaps. Banks weren't always following the rules correctly. People were getting their protected benefit money frozen or seized anyway, and then they had to fight to get it back. Sometimes it took weeks, sometimes it took lawyers, sometimes for people living paycheck to paycheck, or in this case, benefit deposit to benefit deposit. That wait was devastating. So regulators stepped in, and in 2026, the new $250 rule tightened everything up in a very specific way. Let me break this down step by step so it's crystal clear. Under the new rule, banks are now required to automatically identify and ring fence, meaning set aside and protect, a minimum of $250 worth of benefit funds in your account at all times. Think of it like a protected floor. If your account receives a direct deposit from Social Security, a federal pension, or another qualifying government source, the bank must flag those funds and ensure that at least $250 of that money cannot be touched by a debt collector, cannot be frozen in response to a creditor's levy, and cannot be seized without going through a much more rigorous legal process. Now, I want to be honest with you. $250 is not a lot of money. And many of you watching this are thinking, okay, but my whole benefit check should be protected. And you're right to think that. Let's talk about that because it gets more complicated. The $250 figure is the minimum floor that banks must maintain as an automatic, no questions asked, protected buffer. But, and this is where you really need to pay attention, the rule also includes expanded protections for the full amount of your benefit deposit, not just that $250. Here's how that works in practice. When a creditor tries to garnish or freeze your account, your bank now has a federally mandated responsibility to look back at your deposit history, specifically the last 45 days, and calculate how much of the money sitting in your account came from a protected federal benefit source. Whatever that amount is, up to 2 months' worth of benefits must be protected and left untouched. The $250 is just the guaranteed emergency floor that kicks in instantly, even before that calculation is done. So the real protection is much broader. The $250 is just the starting point. That's always there, no matter what. Now let's take a step back and talk about why this matters so much in 2026 specifically, because this didn't happen in a vacuum. There are a few things going on right now that make this rule more important than it might have been 5 or 10 years ago. First, inflation has put a real squeeze on millions of fixed income households. People who are living on Social Security or a pension aren't seeing their income grow fast enough to keep up with rising costs. That means more people are carrying debt, more people are falling behind on bills, more people are getting calls from collection agencies, and that means more people are vulnerable to having their accounts frozen or garnished, even if the money in those accounts is protected by law. This rule adds a stronger layer of enforcement so that banks can't accidentally or intentionally let that slip through the cracks. Second, there's been a significant rise in what financial regulators call wrongful account freezes. This is exactly what it sounds like. A creditor files some paperwork, a bank gets a notice, and instead of carefully sorting out which funds are protected and which aren't, they just freeze the whole account. And then the person who relies on that money for rent, food, medication, that person is suddenly locked out of their own money while the paperwork gets sorted. The new rule creates stricter timelines and clearer procedures that banks must follow to prevent this from happening. If a bank freezes your account and doesn't follow the new protocol, they're now exposed to federal penalties. That's a significant change. Third, and this is something I really want you to hear, 2026 also brought changes to how Social Security payments interact with the broader financial system. The Social Security Administration has been updating its direct deposit infrastructure, and as part of that rollout, banks are now receiving more detailed deposit codes that identify the source of the funds more clearly. That means less ambiguity. That means fewer mistakes where a bank claims it didn't know the funds were from Social Security. The system is being designed to make it harder for anyone, creditors or banks, to plausibly say they didn't know that money was protected. That's a good thing for you. Now, here's what a lot of people don't realize, and I say this not to alarm you, but because this is genuinely important to understand. The rule applies to you regardless of whether you've had any debt or creditor issues in the past. You don't need to be in financial trouble for this to be relevant. Why? Because the rule also affects how banks handle overdrafts, certain fees, and account maintenance charges in relation to benefit funds. Some banks have been quietly applying overdraft fees and service charges against Social Security deposits in ways that, under the new 2026 rule, may no longer be permitted. If your bank has been dipping into your benefit deposit to cover a fee before you even have a chance to use it, that practice is now under much closer federal scrutiny. Let me give you a real example because I think this makes it concrete. Imagine someone, let's call her Margaret. Margaret is 71 years old. She receives $1,140 a month from Social Security, deposited on the second Wednesday of every month. She has a small checking account at a regional bank that she's used for 15 years. 2 years ago, Margaret fell behind on a medical bill. A collections agency eventually got a judgment against her. She didn't fully understand what that meant. 1 month, she woke up, and her entire Social Security deposit was frozen. She couldn't pay her electricity bill, couldn't buy groceries, nothing. She called her bank, and they told her she'd have to wait while they sorted it out. It took 9 days. Under the new 2026 rule, that scenario becomes much harder to happen. The bank is now required to immediately protect that money, calculate the protected amount within a strict timeline, and notify Margaret promptly. Not just put her on hold. Let's talk about what you should actually do right now, because understanding this rule is one thing, but making sure you're protected by it is another. The first thing you want to do is confirm that your benefits are still arriving via direct deposit. I know that sounds basic, but you'd be surprised how many people, especially those who moved, changed banks, or had account changes in the last year, may have a disruption they don't know about. Log into your My Social Security account online or call the Social Security Administration at 1-800-772-2013 and verify that your direct deposit information is current and accurate. A benefit check that gets mailed instead of deposited directly may not carry the same level of automatic bank-side protection under this new rule because the bank side identification of funds depends on the electronic deposit codes. So direct deposit is important, not just for convenience, but now for protection. The second thing you want to do is call your bank or visit a branch and ask them directly, are you compliant with the 2026 federal benefit protection rules? I know that might feel uncomfortable, but you are entitled to that answer. Ask them how they identify protected Social Security or pension funds, and ask them what their procedure is if your account is ever hit with a garnishment notice. You don't need to have a creditor problem to ask this question. You're simply being a smart, informed account holder, and any bank worth its charter will be able to answer you clearly. The third thing, and this one is especially important for people who have a joint account or who have a family member managing their finances, make sure the account that receives your benefit is in your name or includes your name. There are situations where benefit funds deposited into an account held only in someone else's name may not automatically receive the same federal protection trigger. If you're not sure how your account is set up, ask your bank to walk you through the ownership structure. Now I have to talk about something that I never like to have to bring up, but I always do because it matters so much. Whenever there's a new financial rule or regulation, especially one that affects Social Security recipients, the scammers come out, and they are already out there. Right now, people are receiving phone calls, text messages, and emails claiming to be from the Treasury Department, the Social Security Administration, or their bank, telling them that they need to verify their account information to be covered under the new $250 protection rule. Let me be absolutely crystal clear. There is no verification process that requires you to give anyone your Social Security number, your bank account number, your debit card number, or any password over the phone or by text. None. Zero. The real rule is applied automatically at the bank and regulatory level. Nobody legitimate is going to call you and tell you to confirm your information to get the protection. If you get a call like that, hang up. If you get a text or email like that, do not click anything. Call your bank directly using the number on the back of your debit card and call the Social Security Administration using 1-800-772-1213 if you're worried. Go directly to the source always. Here's something else I want you to be aware of as we head deeper into 2026. Some smaller community banks and credit unions are still in the process of updating their internal systems to be fully compliant with this new rule. The regulation was finalized, but implementation timelines give smaller institutions a little more runway. That doesn't mean your money isn't protected. Federal law still applies, but it does mean that if you bank somewhere smaller, it might be worth having a direct conversation with them about their current procedures. Larger national banks, your Chase, your Bank of America, your Wells Fargo, they've had the resources and the legal pressure to implement this fully. But a small regional bank or credit union, check in with them, know where you stand. Let's also talk about what happens if something goes wrong, because I want you to feel empowered, not just informed. If you believe your bank has improperly frozen, seized, or reduced your Social Security or pension benefit funds in violation of these protections, you have options. First, you can file a complaint with the Consumer Financial Protection Bureau, the CFPB, at consumerfinance.gov. They take these complaints seriously, and they have authority over how banks handle benefit funds. Second, you can contact your state attorney general's office, which often has a consumer protection division that handles exactly these kinds of banking issues. Third, if the amount involved is significant, you may want to consult with a legal aid organization. Many of them offer free consultations for seniors and people on fixed incomes, and they are very familiar with Social Security garnishment protections. Here's what I want you to understand about the bigger picture. This rule, imperfect as it may be in some of its details, represents a recognition at the federal level that people who receive Social Security and government pensions have often been the most vulnerable to aggressive debt collection practices. They're on fixed incomes. Many of them are older. Many of them don't have lawyers or financial advisors watching out for them. And for too long, the system relied on those individuals knowing their rights and fighting for them, which is an enormous burden to place on someone who just wants to be able to buy groceries and keep the lights on. The 2026 rule shifts more of that burden back onto the banks and the creditors where it belongs. Going forward, watch for further updates. There are conversations happening right now in Congress about expanding these protections even further, potentially raising that automatic floor above $250, extending protections to state pension recipients who may not currently be covered the same way as federal benefit recipients, and creating faster dispute resolution processes for people who do experience wrongful freezes. Nothing is finalized on those fronts yet, but the direction of travel is toward more protection, not less. Stay tuned because I'll be covering every update as it happens. And one more thing before I wrap up. If you have a loved one, a parent, a grandparent, a neighbor, a friend who receives Social Security or a pension and who may not be watching this, please share it with them. Print it out if you need to. Sit down with them and walk through it together, because the people who need this information most are often the ones least likely to stumble across it on their own. You have the chance to be the person who makes sure they know, and that matters more than you might realize. Don't leave money on the table. Don't let a bank procedure or a collector's tactics catch you off guard when you now have more protection than you did before. Check your account, verify your direct deposit, ask your bank the right questions, know what to do if something goes wrong, and share this with someone who needs to hear it. Because in 2026, being informed isn't just helpful, it's your first and best line of defense.